3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, it's 1 percentage point. Who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. Here's the trend line. Here's the actual line. That wedge gets bigger. So we're 10 years out. We've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. By the way, that definition I gave, a sustained period of below trend growth, that's not my definition. John Maynard Keynes came up with that definition in the 1930s. It was good enough for him. It's good enough for me. I think it's accurate. But being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their third lost decade. The United States has had a lost decade from 2007 to now 2018. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes. You get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So a year and a half into the Trump administration, he's producing the same kind of growth as Obama. And I don't think it's policy driven. I'm not saying one guy's a good guy, one guy's a bad guy. What I'm saying is that the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan, it's true in Europe. Not so true in China, but China's a special case. There's a lot of, they cook the books. Maybe we can talk about that. Their 7-8% growth that they've been printing, cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, they'd be a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. Is debt good or bad? Well, it depends. Debt can be good if you can afford it, if you can pay it off, and you can use it for productive purposes. It's bad if you can't afford it, it's not sustainable, you're using it as a substitute for real growth, and it's all going to crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I've spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later. Very little doubt that the Fed is going to tighten in September. There's my baseline scenario for the Fed is straightforward. They're going to tighten 4 times a year, every March, June, September, and December, 25 basis points each time until they get interest rates up to 3.25%, 3.5%, somewhere in that range, unless one of 3 pause factors applies. The pause factors are disorderly decline in stock markets. Employment starts to go down. Basically, we lose jobs. Unemployment's going up. Or the third one, disinflation or deflation spins out of control, meaning core PCE year over year goes down to 1.4%. Right now it's at 2%. Right now, none of those 3 pause factors applies. The stock markets, they're going sideways, but they're not crashing. The Fed doesn't care if the stock market goes down 15% in 6 months. They do care if it goes down 15% in 6 days. That's disorderly, and that's the kind of thing where you would see the Fed pause, but that's not happening right now. Job growth is strong. Inflation is ticking up. I don't think it'll spin out of control, but we're out of that disinflation danger zone. So none of the 3 pause factors applies. Therefore, you should expect the Fed to just keep raising. So my forecast for September would be yes, and then at this point, December, more likely than not. But the Fed, there's no doubt that the Fed is over-tightening because in addition to trying to get interest rates back to normal, they're also reducing the balance sheet. They're trying to normalize the balance sheet. But now the Fed has a dilemma, which is what are they going to do if the U.S. economy goes into a recession? As I said, we're in the 10th year of an expansion. You know, the old cliche, expansions don't die of old age, is true, but they do die. And history shows that it takes about 4 percentage points of cuts, 400 basis points, in other words, for the Fed to get the economy out of a recession. Well, how do you cut interest rates 4% if you're only at 2%? The answer is you can't. You cut them to zero, and then you're stuck. You're at that zero bound, and the evidence is good that negative rates don't work. So then what do? Well, then you go to QE4. We're going to print some money again. But there, if you had the balance sheet at $4.5 trillion, how high can you go before you destroy confidence? 5 trillion, 6 trillion, 7 trillion? Well, the modern monetary theorists would say, yes, I disagree, and I think the Fed disagrees, but as shown by their own actions in trying to reduce the balance sheet. So what the Fed is doing, they're trying to raise rates to 3, 4%. They're trying to get the balance sheet down to maybe 2 trillion, a little bit less, so that when the recession hits, they can run the playbook again. They can cut rates and, if necessary, do QE. But here's the dilemma. Can you normalize interest rates and normalize the balance sheet without causing the recession that you're preparing to cure? That's the conundrum. I think the answer is no. I think that actually in trying to tighten to get ready for the next recession, they're probably going to cause the recession. There's no data, there's no time series that tells you how this is going to play out, except during QE, what did we see? We did not see a lot of inflation, but we saw asset prices blow up, stocks, real estate, other asset categories. They all went up a lot. So it seems at least kind of first order intuitive that if you print money, asset prices go up. If you destroy money, asset prices are going to go down. So what the Fed is doing, they're destroying money, reducing the money supply. So they're really double tightening. In addition to the 4 rate hikes a year, this reduction in the balance sheet is probably equivalent, this is an estimate, probably equivalent to 4 more rate hikes per year. So they're actually tightening at a tempo of about 2%. Probably going to throw the economy into recession. The Fed has never forecast a recession. They have a terrible forecasting record. This will happen before they know it. Of course, we all know that stocks will go down. So based on that, I'm not bullish on growth. I'm bearish on stocks. I'm bullish on the euro. Gold is actually doing fairly well considering the headwinds. People say, well, gold hasn't gone up a lot. It's true. I'm surprised it hasn't gone down more given the tightening environment that we've described. So gold has actually performed fairly well given the environment. Now, what I do expect is in time, as this, the signs of recession emerge, yield curve inverts, growth slows, job creation slows down, not a full-scale recession or crash, but just enough warning signs, and the Fed reverses course, that all of a sudden they do pause at one of these meetings, gold's going to skyrocket, because that's an admission. At that point, the Fed's throwing in the towel. They say, you know what, we really can't escape the... واغتنموا كذلك الفرصة للاستفادة من أقوى عروض هذا الصيف. اخبار ميزانية ما هي ماشي، الاستهلاك يزيد في الصيف وعليها ترتفع الفواتير. ثبتها ولا تشيل همها. كيف يعني؟ يعني تصير تدفع مبلغ ثابت شهري طول السنة. وعلى أي أساس يحسب المبلغ الثابت؟ على حسب متوسط قيمة استهلاكك الشهري للسنة الماضية. حتى لو زاد استهلاكك بالصيف أمورك تمام. طيب لو كان استهلاكي أقل؟ إذا زاد لك عندهم يردون لك الفرق، وإذا زاد لهم عندك يقسطونها على 12 شهر. يعني تثبيت حدك يا مريح. طيب افرض ثبتها بعدين غيرت رأيي. عادي، تلغيها وترجع للتسديد بالطريقة العادية ببساطة. ألو. وحلو 1500 ايش فيه؟ سجل بالفاتورة الثابتة بدفع مبلغ ثابت طول السنة. We can't get back to normal because when we try, we sink the economy and we have to back off from that. And that's when I think that's when gold will shine, no pun intended, because it'll be very clear that the Fed cannot get out of this easy money mode. One thing I never do, I never make a forecast or make a claim without backing it up. I mean, there are people out there that are a dime a dozen, this is going to crash or this is going to go up or growth is great or it's so, whatever. That's fine, but you need to back that up with some kind of analytics, some kind of data, some kind of analysis that you can do. And I always do that, and I'm always happy to kind of drill down on that. So the methodology I use is quite different from what Wall Street forecasters use. But I've actually recently, with some partners and some scientists and other investors, formed a company to do this. This is a third wave artificial intelligence. First wave is just big data crunching, correlations and regressions. That's fine. Second wave is what they call machine learning. So as the machine is running these, it actually gets data itself and begins to, in effect, reprogram itself based on what it's learned from the correlations it's finding. Third wave, so we do the first two. Third wave, which is what we're doing, is actually closer to cognition. It's teaching the computer to actually kind of think, use inferential method. The frequentist statisticians, and Janet Yellen was a classic example. They just say, more data, more data, more data. Well, fine, but what do you do when you don't have the data? You're trying to solve hard problems. You don't have the data. Use various inferential methods, and machines can do that in what's called a fuzzy way. People don't like the word fuzzy. Cognition sounds soft, but I always say I'd rather be approximately right than exactly wrong. So fuzzy is better than the alternative because it's at least pointing you in the right direction. So that's what my company is called, Miraglim. I'm the chief global strategist. Our product is called Raven. So Raven's a little bit easier to say than Miraglim, but Raven is our third wave AI predictive analytic product. This has roots that go back to 9/11, tragic day, September 11th, 2001, when the 9/11 attack took place. And what happened then? There was insider trading in advance of 9/11. In the 2 trading days prior to the attack, average daily volume in puts, which is a short position, put option buying on American Airlines and United Airlines, was 286 times the average daily volume. Now, you don't have to be an option trader to know, like, if I order a cheeseburger for lunch every day, and one day I order 286 cheeseburgers, something's up. There's a crowd here. I was tapped by the CIA, along with others, to take that fact and take it forward. The CIA is not a criminal investigative agency that you leave that to the FBI and the SEC. But what the CIA said was, okay, if there was insider trading ahead of 9/11, if there were going to be another spectacular terrorist attack, something of that magnitude, would there be insider trading again? Could you detect it? Could you trace it to the source, get a FISA warrant, break down the door and stop the attack and save lives? That was the mission. We called this Project Prophecy. I was the co-project director, along with a couple other people at the CIA. I worked on this for 5 years, from 2002 to 2007. When I got to the CIA, I ran into some old timers. They would say something like, Al-Qaeda or any terrorist group, they would never compromise operational security by doing insider trading in a way that you might be able to find. And I said, I have a 2-word answer for that, which is Martha Stewart. Martha Stewart was a legitimate billionaire. She made $1 billion through creativity in her own company. She ended up behind bars because of a $100,000 trade. My point is, there's something in human. Martha Stewart was a legitimate billionaire. She made $1 billion through creativity in her own company. She ended up behind bars because of a $100,000 trade. My point is, there's something in human nature that cannot resist betting on a sure thing. And I said, nobody thinks that Muhammad Atta, on his way to Logan Airport to hijack a plane, stopped at Charles Schwab and bought some options. Nobody thinks that. But even terrorists exist in a social network. There's a mother, father, sister, brother, safe house operator, car driver, cook, somebody in that social network who knows enough about the attack. And they're like, if I had 5,000, I could make 50, just buy a put option. And they all the crooks and terrorists, they always go to options because you've got the most leverage. And the SEC knows where to look. So that's how it happens. And then the question was, could you detect it? So we started out, there are about 6,000 tickers on the New York Stock Exchange and the NASDAQ. We're talking about second-by-second data for years on 6,000 tickers. That's an enormous, almost unmanageable amount of data. So what we did is we reduced the target set. We said, well, look, there's not going to be any impact on Ben and Jerry's ice cream if there's a terrorist attack. You're looking at cruise ships, amusement parks, hotels, landmark buildings. There's a set of stocks that would be most effective. So we were able to narrow it down to about 400 tickers, which is much more manageable. The second thing you do, you establish a baseline. You say, well, what's the normal volatility, this normal average daily volume, normal correlation of the stock market, so-called beta and so forth. And then you look for abnormalities. So, the stock market's up, the transportation sector is up, airlines are up, but one airline is down. What's up with that? So that's the anomaly you look for. And then the third thing you do, you look for news. Like, well, okay, the CEO just resigned because of some scandal. Okay, got it. That would explain why the stock is down. But when you see the anomalous behavior and there's no news, your inference is somebody knows something I don't. People aren't stupid. They're not crazy. There's a reason for that, but it's not public. That's the red flag. And then you start to, okay, we're in the target zone. We're in this, these 400 stocks most affected. We see this anomalous behavior. Somebody's taking a short position while the market's up and there's no news. That gets you a red light. And then you drill down, use what the intelligence work we call all-source fusion. You say, well, gee, is there some pocket litter from a prisoner picked up in Pakistan that says, cruise ships or something on it? You sort of get intelligence from all sources at that point and drill down. So that was the project. We built a working model. It worked fine, actually worked better than we expected. I told the agency, I said, well, we'll build you a go-kart, but if you want a Rolls-Royce, that's going to be a little more expensive. The go-kart actually worked like a Rolls-Royce. Got a direct hit in August 2006. We were getting a flashing red signal on American Airlines 3 days before MI6 and MI5 and New Scotland Yard took down that liquid bomb attack. They were going to blow up 10 planes in midair with mostly Americans aboard, so probably would have killed 3,000 Americans on American Airlines and Delta and other flights flying from Heathrow to New York. That plot was taken down. But again, we had that signal based on, and they made hundreds of arrests in this neighborhood in London. So this worked perfectly. Unfortunately, the agency had their own reasons for not taking it forward. They were worried about headline risk. They were worried about political risk. You say, well, we were using all open source information. You can pay the Chicago Mercantile Exchange for data feed or the New York Stock Exchange. This is stuff that anybody can get. You might have to pay for it, but you can get it. But the agency was afraid of a New York Times headline, a CIA trolls through 401k accounts, which we were not doing. But it was during the time of, waterboarding and all that. And they decided not to pursue the project. So I let it go. There were plenty of other things to do. And then as time went on, a few years later, I ended up in Bahrain at a financial war game with a lot of, kind of thinkers and subject matter experts from around the world. Ran into a great guy named Kevin Massengill, former Army Ranger, retired major in the U.S. Army, who was working for Raytheon in the area at the time as part of this war game. We were the two American, a little more out-of-the-box thinkers, if you want to put it that way. We hit it off, and I talked him through this project I just described. And we said, well, look, if the government doesn't want to do it, why don't we do it privately? Why don't we start a company to do this? And that's exactly what we did. Our company is, as I mentioned, Miraglim, our website, miraglim.com, and our product is Raven. So the question is, okay, you had a successful pilot project at CIA. It worked. By the way, this is a new branch of intelligence. In the intelligence world, int is short for intelligence, and depending on the source, you have SIGINT, which is signal intelligence. You have HUMINT, which is human intelligence, and a number of others. We created a new field called MARKINT, which is market intelligence. How can you use market data to predict things that are happening? So this was the origin of it. We privatized it, got some great scientists on board. We're building this out ourselves. We partnered with IBM and IBM's Watson, which is the greatest, most powerful plain language processor. Watson can read literally millions of pages of documents, 10Ks, 10Qs, 8Ks, speeches, press releases, news reports, more than a million analysts could read on their own, let alone any individual, and process that in plain language, and that's one.
سيقودك الفضول لدخول منزل أبو خطوة. ستكتشف ما لا ينبغي معرفته. ستتورط حتما في طريق لا رجعة فيه. ستجد نفسك حبيس متاهة. تطاردك الألغاز ويحيطك الغموض من كل ناحية. أحداث حقيقية خلفت وراءها جدلا واسعا. كن مستعدا واحذر أن تقع في الفخ. استمعوا إلى ليلة في جهنم منزل أبو خطوة حصريا على كتاب
one of our, again, important technology partners in this, and we have others. What do we actually do? What's the science behind this? First of all, I'll just spend a minute on what Wall Street does and what most analysts do, because it's badly flawed. It's no surprise that the Fed, every year the Fed does a 1 year forward forecast. So in 2009, they predict 2010, 2010, they predict 2011, so on. Same thing for the IMF, same thing for Wall Street. They are off by orders of magnitude year after year. I mean, how can you be wrong by a lot 8 years in a row and then have any credibility? And again, the same thing with Wall Street. You see these charts, and the chart will show the actual path of interest rates or the actual path of growth. And then along the timeline, which is the x-axis, they'll show what people were predicting at various times. The predictions are always way off the actual path. There's actually good social science research that shows that economists do worse than trained monkeys in terms of forecasting, and I don't say that in a disparaging way. Here's the science. A monkey knows nothing, right? So if you have a binary outcome, up, down, high, low, growth, recession, and you ask a monkey, they're going to be right half the time and wrong half the time because they don't know what they're doing. So you're going to get a random outcome. Economists are actually wrong more than half the time for two reasons. One, their models are flawed. Number two, what's called herding or group behavior. An economist would rather be wrong in the pack than go out on a limb and maybe be right, but if it turns out you're not right, you're exposed. There are institutional constraints. People want to protect their jobs. They're worried about other things than getting it right. So the forecasting record is pretty bad. The reasons for that, they use equilibrium models. The capital markets are not an equilibrium system, so forget your equilibrium model. They use the efficient market hypothesis, which is all the information's out there. You can't beat the market. Markets are not efficient. We know that. They use stress tests, which are flawed because they're based on the past, but we're outside the past. The future could be extremely different. They look at 9/11. They look at long-term capital management. They look at the tequila crisis. Fine, but if the next crisis is worse, there's nothing in that history that's going to tell you how bad it can get. And so they assume prices move continuously and smoothly, so price can go from here to here or from here to here. But as a trader, you can get out anywhere in between, and that's where all these, insurance, portfolio insurance models and stop losses come from. That's not how markets behave. They go like this. They just gap up. They don't hit those in-between points where they gap down. You're way underwater, or you missed a profit opportunity before you even knew it. So in other words, the actual behavior of markets is completely at odds with all the models that they use. So it's no surprise the forecasting is wrong. So what are the good models? What are the models that do work? What is the good science? The first thing is complexity theory. Complexity theory has a long pedigree in physics, meteorology, seismology, forest fire management, traffic, lots of fields where it's been applied with a lot of success. Capital markets are complex systems. They have the four hallmarks of a complex system. One is their diversity of actors, sure. Two is their interaction. Are the actors talking to each other? Or are they all sort of in their separate caves? Well, there's plenty of interaction. Is there communication? And is there adaptive behavior? So yeah, there are diverse actors. There's communication. They're interacting. And if you're losing money, you better change your behavior quickly. That's an example of adaptive behavior. So capital markets are 4 for 4 in terms of what makes a complex system. So why not just take complexity science and bring it over to capital markets? That's what we've done, and we're getting fantastic results. So that's the first thing. Second thing, we use something called Bayesian statistics. It's basically a mathematical model that you use when you don't have enough data. So, for example, if I've got, a million bits of data, yeah, do your correlations and regressions, that's fine. But and I learned this at the CIA, this is the problem we confronted after 9/11. We had one data point, 9/11. We didn't have, now Janet Yellen would say, well, wait for 10 more attacks and 30,000 dead, and then we'll have a time series and we can figure this out. No, as to paraphrase Don Rumsfeld, you go to war with the data you have. And so what you use is this kind of inferential method. And the reason statisticians dislike it is because you start with a guess, but it can be a smart guess. It can be an informed guess. The data may be scarce, but make the best guess you can. And if you have no information at all, just make it 50-50. Okay, maybe Fed's going to raise rates, maybe they're not. I think we do better than that on the Fed. But if you didn't have any information, you just do 50-50. But then what you do is you observe phenomena after the initial hypothesis. And then you update the original hypothesis based on the subsequent data. You ask yourself, okay, this thing happened later. What is the conditional correlation that the second thing would happen if the first thing were true or not? And then based on that, you go back and you either increase the probability of the hypothesis being correct or you decrease it. If it gets low enough, you abandon it, try something else. If it gets high enough, now you can be a little more confident in your prediction. So that's Bayesian statistics. You use it to find missing aircraft, hunt submarines. It's used for a lot of things, but you can use it in capital markets. Third thing, behavioral psychology. This has been pretty well vetted. I think most economists are familiar with it, even though they don't use it very much. But humans turn out to be a bundle of biases. We have anchoring bias. We get an idea in our heads and we can't change it. We have recency bias. We tend to be influenced by the last thing we heard. But anchoring bias is the opposite. We tend to be influenced by something we heard a long time ago. Recency bias and anchoring bias are completely different, but they're both true. This is how you kind of have to get your mind around all these contradictions. But when you work through that, people make mistakes or exhibit bias in, turns out, very predictable ways. So factor that in. And then the fourth thing we use, and economists really hate this, is history. But history is a very valuable teacher. So those four areas, complexity theory, Bayesian statistics, behavioral psychology, and history are the branches of science that we use. Now, what do we do with it? Well, we take it and we put it into something that would look like a pretty normal neural network. You have nodes and edges and some influence in this direction, some have a feedback loop, some influence in another direction, some are influenced by others, etc. So for Fed policy, for example, you set these nodes and it would include the things I mentioned earlier: inflation, deflation, job creation, economic growth, capacity, what's going on in Europe, etc. Those would all be nodes, and there would be influences. But then inside the node, that's the secret sauce. That's where we have the mathematics, including some of the things I mentioned. But then you say, well, okay, how do you populate these nodes? You've got math in there, you've got equations, but where's the news come from? That's where Watson comes in. Watson's reading all these records, feeding the nodes, they're pulsing, they're putting input, and then we have these actionable cells. So, dollar, the euro dollar cross rate, the yuan dollar cross rate, yen, major benchmark bonds, yields on 10-year treasury notes, Blinds, JGBs, etc. These are sort of macro indicators, but the major benchmark bond indices, the major currency cross rates, the major policy rates, which are the short-term central bank rates, and a basket of commodities, oil, gold, and a few others. They're the things we watch. We use these neural networks I described, but they're not just kind of linear or conventional equilibrium models. They're based on the science I described. So all that good science, bringing it to a new field, which is capital markets, using what's called fuzzy cognition, neural networks, populating with Watson. This is what we do at Raven. We're very excited about it, getting great results. And this is what I use. So when I give a speech or write a book or write an article and I'm making forecasts, this is what's behind it. So we talked earlier about business cycles, recessions, depressions, and that's conventional economic analysis. My definition of depression is not exactly conventional, but that's really thinking in terms of growth, trend growth, below trend growth, business cycles, etc. Collapse or financial panic is something different. A financial panic is not the same as a recession or a turn in the business cycle. They can go together, but they don't have to. So let's talk about financial panics as a separate category away from the business cycle and growth, which we talked about earlier. Our science, the science I use, the science that we use with Raven at our company Miraclim, involves complexity theory. Well, complexity theory shows that the worst thing that can happen in a system is an exponential function of scale. Scale is just how big is it. Now you have to talk about your scaling metrics. We're talking about the gross notional value of derivatives. We're talking about average daily volume on the stock market. We're talking about debt. We could be talking about all of those things. This is new science, so I think it would be years of empirics to make this more precise. But the theory is good, and you can apply it in a sort of rough and ready way. So you go to Jamie Dimon and you say, okay, Jamie, you've tripled the gross notional value of derivatives. You've tripled your derivatives book. How much did the risk go up? Well, he would say not at all, because gross notional value is triple, but who cares? It's
اليوم سوف أعلمك كيف إرفاق ضوء السيارة بسرعة. قم أولا بتنظيف سطح المصباح ورشه، ثم ضع اللاصق عليه، ثم استخدم مجفف الشعر لتليين اللاصق، ثم استخدم الممسح للتمليس على طول سطح المصباح.
long, short, long, short, long, short, long, short. You net it all down. It's just a little bit of risk. Risk didn't go up at all. If you ask my 87-year-old mother, who's not an economist, but she's a very smart lady, say, hey, Mom, I tripled the system. How much did the risk go up? She would probably use intuition and say, well, it probably tripled. Jamie Dimon's wrong. My mother's wrong. It doesn't, it's not the net, it's the gross, and it's not linear, it's exponential. In other words, if you triple the system, the growth went up by a factor of 10, 50, etc. There's some exponential function associated with that. So, people think, well, gee, in 2008, we learned our lesson. We got debt under control, we got derivatives under control. No, debt is much higher. Debt to GDP ratios are much worse. Total notional value, gross notional value of derivatives is much higher. Now, people look at the BIS statistics and say, well, the banks actually, gross notional value of derivatives has been going down, which it has, but that's misleading, because they're taking a lot of that, moving it over to clearinghouses. So it's never been on the balance sheet. It's always been off balance sheet. But even if you use the footnotes, that number has gone down for banks, but that's only because they're putting it over in clearinghouses. Who's guaranteeing the clearinghouse? Notice the risk hasn't gone away. It's just been moved around. So given those metrics, debt, derivatives, and other indicia, concentration, the fact that the 5 largest banks in America have a higher percentage of total banking assets than they did in 2008, so there's more concentration. That's another risk factor. Taking that all into account, you can say that the next crisis will be exponentially worse than the last one. That's an objective statement based on complexity theory. So you either have to believe that we're never going to have a crisis, and I'm like, well, you had one in 1987, you had one in 1994, you had one in 1998, you had the dot-com crash in 2000, mortgage crash in 2007, Lehman in 2008. Don't tell me these things don't happen. They happen every 5, 6, 7 years. It's been 10 years since the last one. Doesn't mean it happens tomorrow, but nobody should be surprised if it does. So the point is, this crisis is coming, because they always come, and it'll be exponentially worse because of the scaling metrics I mentioned. Who's ready for that? Well, the central banks aren't ready. In 1998, Wall Street bailed out a hedge fund, long-term capital. In 2008, the central banks bailed out Wall Street, Lehman, but Morgan Stanley was ready to fail, Goldman was ready to fail, etc. In 2018, 2019, sooner than later, who's going to bail out the central banks? And the problem has never gone away. We just get bigger bailouts at a higher level. What's bigger than the central banks? Who can bail out the central banks? There's only one institution, one balance sheet in the world that can do that, which is the IMF. The IMF actually prints their own money. The SDR, the special drawing right. SDR is not strawberry daiquiri on the rocks. It's a special drawing right. It's world money. That's the easiest way to think about it. They do have a printing press. And so that will be the only source of liquidity in the next crisis, because the central banks are not, if they don't normalize before the crisis, and it looks like that they won't be able to, they're going to run out of runway, and they can't expand the balance sheet beyond a small amount because they'll destroy confidence. Where does the liquidity come from? The answer is it comes from the IMF. So that's the kind of global monetary reset, the GMR, global monetary reset. You hear that expression? There's something very new that's just been called to my attention recently, and I've done some independent research on it, and it holds up. So let's see how it goes. But it looks as if the Chinese have pegged gold to the SDR at a rate of 900 SDRs per ounce of gold. This is not the IMF. The IMF is not doing this. The Federal Reserve, the Treasury are not doing it. The ECB is not doing it. If they were, you'd see it. It would show up in the gold holdings. You have to conduct open market operations in gold to do this. But the Chinese appear to be doing it, and it starts October 1st, 2016. That was the day the Chinese yuan joined the SDR. The IMF admitted the yuan to the group of, was 4, now 5 currencies that make up the SDR. So almost to the day when the yuan got in the SDR, you see this just a horizontal trend where first the SDR is trading between 850 and 950 gold per ounce is trading between 850 and 950 SDRs, and then it gets tighter. Right now, the range is 875 to 925. Again, a lot of good data behind this. It's very good. It's another predictive indicator. If you see gold around 870 SDRs per ounce, that's a strong SDR weak gold. Great time to buy gold because China's going to move it back up to 900. So that's an example of science, observation, Bayesian statistics, inference, all the things we talked about that can be used today in a predictive analytic way. The crisis is coming because they always do. I don't have a crystal ball. There's just plenty of history to back that up. It'll be exponentially worse. That's what the science tells us. The central banks will not be prepared because they haven't normalized from the last one. You're going to have to turn to the IMF, and who's waiting there but China with a big pile of gold.
المبلغ المطلوب في قيمة الكهرباء قصته قصة قصيرة وحكايته حكاية بسيطة. خلونا شوي نرجع للماضي، بالضبط قبل ما يرصد المبلغ المطلوب، ونتعرف على الأحداث اللي صارت في رحلة الرقم الأهم بطل هالحكاية. الرحلة بدأت بقراءة موظف الكهرباء للعداد لاستخلاص الرقم الأهم اللي هو كمية الاستهلاك، وبعدها ترسل رسائل لتبليغ المشتركين بقراءة العداد. بس وش دور كمية الاستهلاك وليش هو الرقم الأهم في فاتورة الكهرباء؟ طيب، كمية الاستهلاك تحدد قيمة الاستهلاك، وهنا تكمن أهميته، ونقدر نتأكد منها بمعادلة بسيطة ننقص فيها القراءة الحالية من القراءة السابقة، والناتج هو كمية الاستهلاك. وإذا ضربنا كمية الاستهلاك في سعر الشريحة يكون الناتج قيمة الاستهلاك. وكل هالمعادلات تقدر تحسبها بسهولة وتتأكد منها بكل بساطة من خلال خدمة حاسبتي المقدمة من الشركة السعودية للكهرباء، اللي أيضا تقدر من خلالها تتعرف على القيمة التقديرية للاستهلاك الحالي لخدمة الكهرباء، وتحسب المبلغ التقديري للفاتورة القادمة وقيمة الاستهلاك غير المفوتر. حمل تطبيق حاسبتي واحسبها صح. استهلاكك هو الرقم الأهم. الشركة السعودية للكهرباء.
سيقودك الفضول لدخول منزل أبو خطوة. ستكتشف ما لا ينبغي معرفته. ستتورط حتما في طريق لا رجعة فيه. ستجد نفسك حبيس متاهة تطاردك الألغاز ويحيطك الغموض من كل ناحية. أحداث حقيقية خلفت وراءها جدلا واسعا. كن مستعدا واحذر أن تقع في الفخ. استمعوا إلى ليلة في جهنم، منزل أبو خطوة، حصريا على كتاب صوتي.
To internal consumption of services. You know, your experience in China, how does the picture on the ground of the Chinese debt situation differ from perhaps the way people see it from the US and Europe when they're looking onto the inside?
Well, the debt intensity of China took on new proportions in the aftermath of the financial crisis. Going into the financial crisis, debt to GDP in China the ratio was about 150%, which was a little higher than it had been, but was not an outlier relative to other nations, if that in fact is a comparative metric that I want to use. But in any case, after 2008, the ratio exploded. And today, that same ratio, which pre-crisis was 150, is about 262%. And that's worrisome. And so the debt intensity of the Chinese GDP has increased dramatically. If you pick apart the sources of that debt, you will find that it was not the household sector that did it, it was not the government sector that did it, but it was largely this big increase in corporate debt And if you look further, you find that it was in the state-owned enterprises that really became the drivers, the engines of debt-intensive growth. And there's been a lot of discussion about this actually inside of China. There was a famous interview about 3 years ago, 2.5 years ago, that was published on the front page of the state newspaper, People's Daily, that contained an interview between the editor of the People's Daily and someone who did not want to divulge his identity. So he became known as the authoritative person to indicate that he was a high-level, very well-connected official, but did not want to disclose his name, which is a little weird, but that's just the way they did it. And he said, China's on a tough and dangerous course, very reminiscent of the experience of Japan. And he laid out the whole Japan model, debt-intensive growth, underpinned by asset bubbles that when they burst pose a risk to levered companies in Japan, the levered companies that got dragged down by the bursting of the equity and property bubble in the early 1990s became known as zombies, and that, the economic walking dead, and that unleashed a whole conversation that's still going on today about the incidence of zombies in China and their relationship to debt-intensive growth. And the bottom line is the Chinese government is very cognizant of the risk of a replay of a Japanese-like scenario, and they're very focused on avoiding that. And, you know, I give them a lot of credit for that in naming and owning up to the major risk of debt-intensive growth. I teach a few courses at Yale. One of the courses I teach in the spring is called The Lessons of Japan, where I go through the rise and fall of modern Japan and then try to distill some lessons that has for other countries, including China. And I've been asked to and teach parts of that course in China for the last 3 years. Japan, where I go through the rise and fall of modern Japan and then try to distill some lessons that has for other countries, including China. And I've been asked to and teach China by one number and one number alone, whether it's debt to GDP or GDP, and say, this is the problem. And I need to do more than that.
Well, what about the currency? Because the currency is obviously at the center of a lot of this, and that codependent relationship is changing, as you said. China seems to be trying to find a way to have less need for dollars, and certainly their treasury holdings are declining over time.
A little bit, not a lot.
Yeah, a little bit, but it's pretty steady now. It's been since 2013. It's been a pretty steady reduction that suggests this is a change in direction for them. What do you think about the currency? Because it seems to, again, hold the key to a lot of potential moving parts that float around it.
Well, I think the currency was enormously important when China was deriving so much growth from export.
فاتورة الكهرباء الجديدة صارت أوضح وأسهل. المبلغ المطلوب سداده صار أوضح. لا وفصلنا البيانات المالية والفنية عشان تسهل عليك قراءتها، وبكذا تقدر تتأكد من كمية.
Because that's the sort of the way in which Chinese goods are priced relative to other goods, and certainly there was evidence that the Chinese, like their predecessors, the Japanese, were deliberately holding the currency down to gain competitive advantage in the early 2000s, maybe going up to 2012, 2013. Since then, they've allowed the currency to rise a lot. But the currency helps you compete if you're an exporter, but you need a stronger currency to expand the purchasing power of your consumers as they start to come to life in attempting to realize their demands for foreign-produced goods. And so the government's allowed the currency to appreciate, although recently, in the last 9 months or so, it's come down pretty sharply again. So I think, the currency is one important policy lever in China that has meant different things for the Chinese leadership at different phases in its growth cycle. And cheap currencies help exporters, and that was the case for China when it had export-led growth. Strong currencies help consumers, and with the exception of the last 9 or 10 months, that's been the case over in China as well.
We touched on Donald Trump, the big outlier since you wrote the book. So let's talk about the Trump effect on the relationship between America and China, how it's changed, how each country sees the other perhaps, and also the trade wars that are happening, which we just can't ignore them. They seem to be escalating. There's an awful lot of talk trying to calm and quieten the horses that we've got this under control. But it seems to me, if you look beyond the rhetoric from the people in the discussions, it's steadily escalating, and it seems like a battle neither side can afford to back down from. So let's start with the Trump effect. What effect has Donald Trump had? Has he just reset the boundaries of this, or has there been a bigger change than that since he took the helm?
Well, I think President Trump has really brought a troubled relationship to a head. Again, going back to my earlier framework of codependency. Codependency is not a healthy or sustainable relationship between humans, and I warned of that when I wrote this book, that ultimately there would come a time in this bilateral economic relationship where one partner, either the U.S. or China, would feel threatened by the other and lash out in response. I did not, when I wrote the book, certainly envision the election of a president like Donald Trump, who would seize on the bilateral trade imbalance as a means to really tighten the screws dramatically on China. And as much as I object to tariffs and trade wars, I will give the president credit for bringing out into the open debate on very important issues, whether it's bilateral trade deficits, which most card-carrying economists, myself included, would tell you not to focus on, but to these thorny issues of technology theft, intellectual property rights, a state-directed system versus a market-based system, cyber hacking. These are all allegations that were explored in great detail by the Trump administration's trade representative, Robert Lighthizer, when he issued this report in March of this year regarding the unfair trading practices as alleged under what is called Section 301 of our Trade Act. In his report, 182 pages with over 1,000 footnotes, which every one of which I've read, brings out and crystallizes a lot of issues that have worried a lot of people for a long time. I've read the report carefully. I think it's poorly done. I think it's politically biased. But, there's a lot of issues that don't necessarily get expressed fairly and accurately by politicians, but we debate them because they're important to debate. And so the Trump administration, to its credit, has put these issues on the table for all of us to debate, and that's a good thing.
But what happens to that debate? Because it's a debate that realistically it's very difficult to have between America and China, because the accusations particularly around IP theft and hacking and spying and all that kind of stuff, that it really is the stuff you don't talk about at parties. When you bring that stuff out and you put it out on the table, it's very hard to have a debate about that in good faith on both sides, because the quantum of being exposed or being wrong is so high. And to do that within a wider framework of trade wars, is that, A, is it a good idea, and B, can it work? I'm not sure it can.
Well, I would say not that, this has become the hottest topic of conversation in social circles or parties that I go to, but there is a recognition that these issues have now driven an enormous wedge between us, the largest economy in the world, and China, the second largest, and a lot of sort of casual empiricism has recognized that this conflict, this pattern of conflict between the rising power and the ruling power, has a tough history that can end in outright hot wars. Sure. There's a professor at Harvard, Graham Allison, who's written a book called The Thucydides Trap that talks about this. And so, and then, Michael, Vice President Pence, along with former Treasury Secretary Hank Paulson very recently, have both laid out the possibility that, well, if it's not going to be a hot war, there's a good chance it's going to be a Cold War. And we know what a Cold War was like with the former Soviet Union. So, I don't mean to say this is a burning issue in every cocktail party, but it's an issue of increasingly important consequence in the discourse of international problems that I think many observers are now facing for the first time in a long time.
So with this codependent relationship, and it's clear to see the nature of that codependency, but who, if anybody, has the upper hand? Because it seems to me, looking at it, that with the US deficits getting bigger and their need to fund ever bigger deficits based on some of the Trump policies, I kind of feel like China almost has the upper hand here, but I'm
but you're alone in that, because I wouldn't say alone, but clearly the Trump administration harbors the belief that the U.S. economy is now strong because of the president's tax cut and regulatory relief, and the Chinese economy, the growth rate is slowing. The stock market's down some 30% this year, and China is weak. So why not go after China right? Can be corroborated by evidence. Give them a lot of credit for that, and in naming and owning up to the major risk of debt-intensive growth. I teach a few courses at Yale. One of the courses I teach in the spring is called The Lessons of Japan, where I go through the rise and fall of modern Japan and then try to distill some lessons that has for other countries, including China. And I've been asked to teach parts of that course in China for the last 3 years, and I do.
Whichever view you have on China, whether you're bullish or bearish, you seem to be able to find exactly what you need to not only back up your case but strengthen it.
Isn't that true of any view in the markets? I mean, you talk to a lot of market guys.
Yeah, but it is. But I think China particularly, because there's that certain amount of opacity about everything that comes out of China. You never really know.
Yeah.
And the narrative around it is that you're going to get told by the CPC exactly what they want you to hear, and you're never going to get the real truth. So can we believe anything? But it does seem that
you hear that a lot. And like I debated at Yale just the other day one of the most prominent China bears. Again, I won't mention his name, but he wrote a book in 2001 called The Coming Collapse of China, so you can do an internet search.
Yes,
figure out who it was.
Yeah.
And he's a great guy. But he said, to your point, you can't believe the numbers in China. They publish 6.5% or 10%, but I know the numbers are one.
Right.
How do I know it? Well, I look at this or that gauge, and so I conclude that, I know more about the Chinese economy than the published data lead you to believe. And you're right. There's a lot of sort of outside experts or doubters about China who will say the same thing. You can't trust the information that the government puts out, and so we know that the place is a lot weaker than that.
But I guess that's the problem, really, because if everyone's getting the same data, it's just down to interpretation. Whether the data's right or wrong, it's the only data we have. People go in and try and come up with their own data sets, and generally those tend to be bearish, or certainly more bearish than the government's, which would suggest that they do massage the figures in a favourable direction to them. But when you look at some of the numbers that some of the bears are coming out with in terms of the sheer levels of debt, it's hard to see how you gently work your way out of something like that without some kind of major correction happening, kind of suddenly.
Well, look, that's why, I've often felt, whether it's looking at the U.S. economy, the European economy, the Chinese economy, the Japanese economy, that you've got to do more than just focus on, headline GDP or headline debt. You need to look at the pieces of the puzzle, how they fit together, and whether or not the logic of that puzzle can be corroborated by evidence that the government does not put out, that others have assembled, or that you can look at through your own analytical lens. And so, so much discussion about China is, well, GDP was 10 and now it's 6.5. And so that's a 35% reduction in their growth rate. And then adjusting for the well-known biases of whatever it is, 2, 3, 4 percentage points, the economy is already terribly weak. The day of reckoning is at hand. That's what I hear all the time. And, they'll look at other things like, property bubbles or the environment and say, see, I told you. I'm suspicious of that. I really am. I mean, the overall GDP in China to me is far less important than its pieces. And the pieces that I've looked at, also aggregate, but break down the GDP into its three major sectors: primary or agriculture and mining, secondary manufacturing, construction, and tertiary services. And if you look at just those three pieces of the puzzle, since 2007, when, again, my favorite sort of provocateur of the debate, Wen Jiabao, said the Chinese economy was unbalanced, there's been a big shift away from manufacturing and construction, increasingly towards services, which is the infrastructure of consumer growth. I mean, when he made his famous comments that I alluded to earlier, the services share was about 42% of Chinese GDP. Today it's 56, 57%. It's still too small.
Yeah.
But that move in 10 years from 42 to 56 is extraordinary indications of structural change. And so that service-based economies, whether they're developed or developing, they grow more slowly. And so how much of this slowdown in the growth from 10 to 6.5 reflects the shift, deliberate, to slower growing services activity to achieve their goals of a more balanced economy? I don't think the bears really get into the shifting composition. They want to judge China by one number and one number alone, whether it's debt to GDP or GDP, and say, this is the problem. And I need to do more than that.
Well, what about the currency? Because the currency is obviously at the center of a lot of this, and that codependent relationship is changing, as you said. China seems to be trying to find a way to have less need for dollars, and certainly the treasury holdings are declining over time.
A little bit, not a lot.
Yeah, a little bit, but it's pretty steady now. It's been since 2013. It's been a pretty steady reduction that suggests this is a change in direction for them. What do you think about the currency? Because it seems to, again, hold the key to a lot of potential moving parts that float around it.
Well, I think the currency was enormously important when China was deriving so much growth from exports, because that's the sort of the way in which Chinese goods are priced relative to other goods. And certainly there was evidence that the Chinese, like their predecessors, the Japanese, were deliberately holding the currency down to gain competitive advantage in the early 2000s, maybe going up to 2012, 2013. Since then, they've allowed the currency to rise a lot. But the currency helps you compete if you're an exporter, but you need a stronger currency to expand the purchasing power of your consumers as they start to come to life in attempting to realize their demands for foreign produced goods. And so the government's allowed power of your consumers as they start to come to life in attempting to realize their demands for foreign produced goods. And so the government's allowed the currency to appreciate, although recently, in the last 9 months or so, it's come down pretty sharply again. So I think, the currency is one important policy lever in China that has meant different things for the Chinese leadership at different phases in its growth cycle. And cheap currencies help exporters, and that was the case for China when it had export-led growth. Strong currencies help consumers, and with the exception of the last 9 or 10 months, that's been the case over in China as well.
We touched on Donald Trump, the big outlier since you wrote the book. So let's talk about the Trump effect on the relationship between America and China, how it's changed, how each country sees the other perhaps, and also the trade wars that are happening, which we just can't ignore them. They seem to be escalating. There's an awful lot of talk trying to calm and quieten the horses that we've got this under control. But it seems to me, if you look beyond the rhetoric from the people in the discussions, it's steadily escalating, and it seems like a battle neither side can afford to back down from. So let's start with the Trump effect. What effect has Donald Trump had? Has he just reset the boundaries of this, or has there been a bigger change than that since he took the helm?
Well, I think President Trump has really brought a troubled relationship to a head. Again, going back to my earlier framework of codependency. Codependency is not a healthy or sustainable relationship between humans, and I warned of that when I wrote this book, that ultimately there would come a time in this bilateral economic relationship where one partner, either the U.S. or China, would feel threatened by the other and lash out in response. I did not, when I wrote the book, certainly envision the election of a president like Donald Trump, who would seize on the bilateral trade imbalance as a means to really tighten the screws dramatically on China. And as much as I object to tariffs and trade wars, I will give the president credit for bringing out into the open debate on very important issues, whether it's bilateral trade deficits, which most card-carrying economists, myself included, would tell you not to focus on, but to these thorny issues of technology theft, intellectual property rights, a state-directed system versus a market-based system, cyber hacking. These are all allegations that were